So I saw this, thought it was interesting. So there's an economics researcher who's warned about a big stock market collapse. So first we're going to look at this for a moment, and then I want to talk about my opinion, what I think about this. Finnish economist suggests it's going to be a big crash. It's going to last a long time. Thinks US stock growth is unsustainable. And a crash is bound to happen in the coming decades. I don't think he says a date, but let's see. He thinks that there's going to be an Armageddon and a big financial crisis. Events have rattled markets. It seems very macro. Anyway, let's keep going. Fed has hiked rates 450 basis points to fight inflation. Economists warn there's a big recession coming. I don't disagree with them. I'm going to cover this ad because he wants to see. Whoa. Senor, what's going on here? There we go. See my pretty face instead of those stupid ads. Bear with me a sec. So the paper examined past studies of stock market crashes, yada. Pool data from like 200 years, stock market bubbles, blah. And he's comparing this crash to 1987 and 1929. I do have some things I want to talk about in a moment about this, some other data sources. Let's keep going. For both events of these past events, October 1987 and October 1929 Great Depression, market participants observed extreme reductions in market capitalization. It was a crash, obviously. Last week, a big investor, Jeremy Grantham, warned investors of a stomach-churning crash that could wipe away 50% of the S&P. Ray Dalio, someone I respect a lot, has also warned about a new world order and could easily see that interest rates could spark a 20% plunge in stock valuations and a severe recession. Okay, what do I think? Well, I'm glad you asked. I do have some thoughts. A couple of things I found in the last few weeks. I'm going to talk about the UK and the US, and I'm going to relate it to the rest of the world because I think a lot of these things are global trends. Number one, in the UK, insolvencies, corporate insolvencies are at the highest since 2008, and they're climbing every month. That to me signifies that even before the data, the kind of rosy data that's happening and coming out at the moment, people are somehow surprisingly feeling quite optimistic about the future or the short-term future. I think that the corporate insolvencies, the fact that they're increasing could spark a recession. Just that could spark a recession. Your company's going bust, layoffs, unemployment rates going up. Lost capital means investors are going to lose money as well. Those that are backing those companies, wealth is going to decrease. That's number one. So that's corporate insolvencies are at an all-time high, over the last period. Number two, I think it's 1.5 million people need to remortgage in the next 2 years. I think it's about 700,000 in 2023. And a lot of these people have to remortgage on the higher rates. Now, for context, in the UK, I also found out 50% of all homeowners do not have a mortgage. So it's not going to affect those people. But for the rest of us who do have mortgages, this could be another factor. So there's so many people that need to remortgage, and a lot of them need to remortgage on double or triple or quadruple the rates that they were used to in the last 5-6 years. That alone is going to restrict discretionary income, and that's going to restrict consumer spending, which can cause an impact for a lot of companies out there. That's number two. Number three is what this guy has cited about interest rate rises. I think that only adds to what is already happening. And if mortgage rates continue to rise, and if corporate debts as well are often linked to the base rate as well. So also, then another thing, the fourth thing is institutional investors and pension fund managers, if they can get a bigger rate of return or a safer rate of return from bonds, then they're going to cycle out of stocks. So, what do I think about all these things? I think that they're the factors, they're not thoughts. These they're just data points. But I do think they add up to something. I think there's going to be sections of society that are going to suffer greatly in the next few years, and there might be cyclical layoffs because of interest rate rises and because of the squeeze on discretionary incomes. I'm kind of also a little, I do have other counterintuitive opposite thoughts that robotics, AI is deflationary and helps companies to save money, and their margins will grow. So I'm going to park those for now. I've talked about those in other videos. So I'm going to focus on the potential of a crash and what can we do about this. Well, the 4 factors I mentioned, I think, are pretty strong indicators. This guy's just looked up the guy that I was talking about in the video earlier. That researcher has looked at stock market data. I've talked about real economic data. Stock market data, charts and things are a reflection of, to a certain extent, fear and greed and lots of other variables, people buying and selling and whatnot. But I think the factors I've just mentioned, the fact that people have to remortgage, they have to live somewhere, 50% of people in the UK, I'm sure it's the same in the US and other countries, governmental debt is pretty high. The government indeed has a stake in the economy, in the residential market, because in the UK, the UK government has got embroiled in something called Help to Buy, where they own, is it 20% or 25%, something like that, of a lot of the residential market and a lot of this debt. And that could put the government also in some issues as well. So that's a 5th reason. I don't know if every country has kind of come up with some of these schemes, but I think the UK, in my mind, in particular, from a macro perspective, is at risk of having a big correction. But here's the but, and if you stayed around until the end of, until this part of the video, congratulations, because I do think this is the most important thing, and that is, we're just talking about prices. We're not talking about value. So, famously, Warren Buffett says if his favorite stock picks go down in price, he doesn't panic, he buys. And this is why, in my mind, it doesn't really matter if the stock market goes down, because as long as as investors, we can prepare and we are able to continue to purchase stocks, then you're going to get them at better rates. The companies I follow, have done interestingly, in the last 3 to 6 months, I've talked about on this channel, Catebox, which has gone up about 50% in 3 months. Or Tia, which I don't think has gone up yet, but I think there's value there. People need to keep eating, and it's a low cost option. Just like people need to keep buying birthday cakes every year for Catebox. And NatWest, which is a bank, and that's gone up like crazy the last few months as well. So I think it's more important to focus on value. Prices can fluctuate. When I make a video that a company could 5x or 10x or whatever, I don't know when it's going to happen. And I don't think, if somebody says, I know when XYZ is going to happen, I think you should be quite skeptical. I have made certain predictions in the past about, COVID, interest rates, and, I've been right, but that's not the point. The point is that it's hard to know when things are going to happen. In March 2020, I also predicted the financial crash and made quite a lot of money from options trading, which is a strategy you can look at if you think when a crash is going to happen. Importantly, a lot of people that have made money on options trades lose money the next time. Mark Cuban famously predicted a crash and lost quite a lot of money the first time round. Then the second time he predicted, he got it correct and made a lot of money. Another example online is there are people that made a lot of money on Tesla call options. Like, some people made millions, but then they tried to do it another time and they lost millions. So options trading, I'd say, is I like it, but it's hard. It's like one of the hardest things to do, I'd say. It's very, very difficult, but if you get it right, wow, it's amazing. Nevertheless, going back to the value thing, like if you think there's value, for most people, it's good to buy when you see value. And if the price goes down, in my mind, this is not advice, it's just kind of how I view this kind of thing. Buy when you've got value, and at some point in the future, the value will be realized. I hope this has been interesting. I hope you like my new t-shirt. This is an Instagram t-shirt. It's funny because don't really use Instagram that much, but I really am a massive fan of merchandise. Merch, I think we call it here at Meta. But yeah, anyway, I hope you like this video. Like and subscribe. I've got videos about finding value in the equities markets, as well as angel investing, which is a bit of a more longer term play. And I may even start making some videos about property, because I see some potential pockets of value there as well. Like and subscribe. Remember, the knowledge is power, especially the right kind of knowledge and progress. So I think there'll be some other awesome videos, or at least I think they're awesome. Hope you do as well, appearing soon. And I'll see you guys in the next upcoming video. Take care.